let's go.
Alrighty. Alrighty, it's loading right now. All right, Peter, we're going live right now.
Okay, sounds great.
How's everybody doing today? How are you doing today, Peter?
I'm doing good. Good to be back with you here, and lots to talk about. So hopefully not boring times. As they say, Happy Chinese New Year, and we are living in interesting times. Thank you, Chinese proverb.
Yeah, it's been a while. We haven't talked in a long time here. So I got
I
go ahead.
lost track, actually. I think it's like 6 months ago at least. So.
Yeah, it's been a long time here. So my questions are going to be a little longer than normal just because we haven't talked for a while. So I'll just give you a little background on each one. But let's just get started here right away. So the first thing I wanted to talk about was the feds. A lot of people sit here and think they can push this on forever and ever. And, what I've been saying is they're kicking too many cans. You have too many bubbles at this point. And they're all now, stacked into a little mountain. That mountain's eventually getting too big to kick. So one of the things I wanted to talk about was how I've always said that they had to either pick saving these banks or they're going to eventually have to pick fighting inflation. You've seen the Fed's now ending the bank lending program. They also raised the rate, so banks stopped abusing it and using it on arbitrage plays for the other on treasuries. So they also are trying to push banks now towards the federal discount program. They now want everyone to use it once a year to get away from that stigma that's attached to it. So because they don't want bank runs for people to use that, but that way they can be in more control. They're also passing a merger law, so bigger banks can no longer absorb smaller banks if they have the too big to fail label attached to them. 1 second here. They're also not cutting rates, which is hurting them, and they're actually standing their ground on the endgame rule that's coming up in 2025 as well. What are your thoughts here on, are the feds finally starting to tame the corruption a little bit, or do you think I'm just overlooking this?
No, so obviously you talk about the Federal Reserve and Treasury and everything combined. It's there's multifaceted issues. I said it's problem optimization. And here's the issue. The biggest problem is that since again, I'm going to sound like Putin here, but in 1971, President Nixon took the U.S. off the gold standard, and so what that meant is you have a currency that's basically not backed by anything except for the full faith of the U.S. government. That sounds all very well nice, but when that government starts, spending more than it takes in, and again, that's an accounting gimmick anyway. You can always fiddle with numbers to try and make it look better, but ultimately it becomes obvious that the government's been on a very inflationary path since the 60s, but of course accelerated in the 70s. So in the late 70s, early 80s, the Federal Reserve was faced with a credibility problem. Too many dollars being printed, and not enough goods being produced to offset that. So the head at the time of the Fed was Paul Volcker, and Paul Volcker said, "Well, where our credibility is at stake, we have to do something to regain confidence in the value of the dollar." And so they hiked aggressively rates. If you wanted to get a litmus test, so this is why gold and silver were extremely higher in the early 80s. In fact, the Hunt brothers cornered the silver market, but they were cornering a market that was already bid no lid. So it was really just a sign of the public perception that the dollar was kind of being devalued, and people were streaming into precious metals. So when you talk about golden offset for inflation, it all goes back to obviously more than just the last 100 years, but in particular the late 70s, early 80s. The Fed was brought into a corner. They had to raise rates, and Volcker raised rates to 18%. 15% or whatever it was, but I remember my dad was paying a mortgage of like 18% at one point in 1982. So rates globally went skyrocketing in the 80s, and that basically, cratered inflation caused a mini economic slowdown that only that was one contributor to Jimmy Carter's not being reelected in 1980. Of course, Ronald Reagan and the Iran thing and everything else. But fact is that the Fed basically killed any kind of momentum in the economy for several years to get their credibility back. Now, they were able to do this because even with all this money printing going on in the 70s, the overall federal debt wasn't that large. So that was doable. It didn't kill the U.S. ability to pay its debt because the interest rates were high, but only for a few years, and the debt base that they were financing wasn't that much. Now you go through since then, and every Federal Reserve, it started with Bernanke. It started with Greenspan in 1987, the Black October day. Basically he came in and it wasn't as overt as it is now, but they basically he came in and they made concession changes and things that became what's known as the Greenspan put. And it's like, wait, we will not let the equity markets melt down. And so consequently, since then, we've had people like Bernanke come in, and Bernanke's popular theory was, well, you can you don't have to worry about inflation. You can always fight inflation, and he's pointing to Wackler's action successfully taking down inflation. But uh, the issue is that he was so worried about deflation, and because he studied the Great Depression as his thesis, so it's like, oh, we've got to avoid deflation at any cost, and you can always do that by printing money. So Bernanke was the guy, and again, he had Japan as a case example where Japan was basically quantitative easing by printing money to buy bonds. And so he said, well, Japan's been doing it. Of course, it's not the same comparison, and Japan has never really recovered from a property explosion in the 80s, but that's another whole nother story. But anyway, so Bernanke created this huge quantitative easing problem because he said, yeah, we can just print enough money to offset any kind of deflationary scenario. So when 2007, 2008 happened, it's like, yeah, okay, we're going to violate confidence in money even more by printing money to buy bonds. And it's quantitative easing, but don't worry, we'll normalize the balance sheet. And so he subsequently got left out, and then Yellen came in as head of the Fed. And again, it's like, well, don't worry, it's a you know Federal Reserve balance sheet's 4 trillion, but we'll normalize it back to a trillion as it was in 2007. Well, she got down to 3.7 trillion, and then she gave up, and because a variety of reasons, the economy had issues, and then we had a repo crisis in 2019. And before you know it, Jay Powell is basically carrying on with Yellen's work of not normalizing the balance sheet, and then 2020 hit, and all things went to hell. So again, the balance sheet never got normal before 2020, and then the gates were opened in terms of mass quantitative easing, and the balance sheet went up from 3.7 trillion to what, 9 trillion. So that's a Fed balance sheet. That just tells you the degree of monetary expansion that went on. So they basically, again, with the Bernanke thesis, it's like, yeah, well, we're this is all controllable. We want to avoid deflation at all costs. But the fact is that again, it undermines confidence in the value of the currency when you start printing money like this, and that's why they started gaslighting us back in 2021, saying, there's no inflation. If there's inflation, it'll be transitory. Even a little bit of inflation is not a problem, guys. Don't worry about it. We can take care of it. And so 2022, we obviously see the inevitable push in inflation. And at that point, whatever credibility the Fed had left was gone. And you could argue that Jay Powell, what it is now is you've got to the situation where, okay, they had to raise rates at the most aggressive pace they ever have. It's not the highest obviously rate. So we got to what, 5%, but Volcker put it to 18%. But the fact of the matter is that the scale of how the pace, like to have 75 basis point hikes every meeting, for three months in a row, it's like, or whatever, three meetings in a row, it's like that was significant. So we're not used to this. But the other side of it is, did he successfully clamp down on inflation? And you could say, well, we've been seeing disinflation for the last year, where inflation is still high, but it's not as high as it was. So you're seeing a declining rate of inflation. the Fed's target is they don't have an actual target, but their de facto target is the same as the Bank of Canada, which is a 1 to 3% band. So they got inflation close to that 3% band, but they haven't got it under yet. So from that sense, if they're trying to say we have successfully, dealt with the inflation issue, well, they technically sort of have, but they haven't got it below 3%. And they're not going to be willing to admit that they're done hiking until they can see that below 3%. The other issue, of course, is the strength of the economy. They can't be seen as being saying that the economy is strong if the economy is creating 380,000 jobs every month, as the last non-farm number indicated. It's like, well, that if we're going to cut rates, that just adds more fuel to the fire, and that'll be inflationary. So we can't if they're worried about their credibility, then as a monetary authority, you cannot be seen as cutting rates in an environment where the job market is creating 308,000 jobs a month. Now, so that's one side of it, and the other part of it is, of course, that the data from the Bureau of Labor Statistics has been very unreliable. There's another job survey called the employment cost. Sorry, not the employment cost. Great. I can never remember this stupid thing. It comes out on the Wednesday, and I'm having a mental blank here, but it's another employment measure that comes out, and it's been completely different from what the non-farms number has been. And then there's the issue with the non-farms data being revised every month, except for the last month they didn't revise it down. But you've got months and months and months where the previous month was revised lower. So the BLS, what are they doing? And I think part of it, well, I know what the reason is. It's basically because of immigration. You have mass immigration coming in, whether it's legal or illegal in the U.S., and that's creating a huge distortion in demand. Because all these people that are coming in, whether they have money or not, they need food. If you look at the stories, it's like New York City is paying, immigrants like, to live in a hotel, and they're giving them, expense vouchers for food and all this. Well, so they're getting funded, and they need to eat, and they need to travel or get clothes or whatever. So that creates demand. And so, yeah, you're getting service industry jobs being created to service all these people coming in, whether it's cleaning or building a houses for them or whatever. So it is stimulating the economy. So it gives the illusion that the economy is growing. At the same time, you see, you look on X. I repost this stuff every day. It's like so and so is cutting 4,000 jobs. So and so is cutting 5,000 jobs. So it's like from what we see information wise, it doesn't look like the economy is creating, like, there should be some negative clawback because of all these job losses, but yet the job numbers keeps pointing to a very strong economy. So from the Fed's perspective,
hold on a second, Peter, not to cut you off, but that also is because you also have to look at more people are working 2 jobs now in the United States than ever, and they're counting that as people working too as well.
Absolutely, that's an excellent point. And we see this in Canada too. The full-time jobs just decreased like 11,000, but part-time was up 48,000 something. So it's like, oh, you have 37,000 jobs created last month. Well, it's all part-time jobs, and it's people working gigs. So yeah, exactly. The data is misleading, and meanwhile, the Fed is relying on this data to justify not cutting. So that's where they're at. They're desperately trying to re-engage that confidence that they've lost. Now, the problem is that in my view, they'll never get it back. But they're keeping the pantomime going that they have to be worried about inflation. Now, the other side of it, and you just pointed out, they they have run into a problem with terms of being able to keep hiking rates. So there's so many different issues, but I don't even know where to start, to be honest. But let's deal with the regional banks, because that's the biggest eyesore at the moment. So the commercial real estate market is a disaster in the U.S. And every day it seems I see, like, oh, this building was bought in 2018 for 200 million. It just sold for 80 million. So there's a huge amount of property losses going on. And if historically, who's been funding all this real estate acquisition? It's been not the super mega banks, more or less. In the U.S., it's been all the regional banks. So to even try and be competitive with the major global banks, they have to cater to whatever market sector they can get. And in the U.S., it's all about real estate. So whether it's malls or strip malls or whatever type of building, the regional banks have been all over it, and it's been profitable while there's easy liquidity. But once the Fed started raising rates, and we've talked about this previously, there was no flight of deposits out of banks when the Fed went from 1 to 2%. When it went to 2 to 3%, not really. When it went to 3 to 4%, no. But once money market rates got above 5%, it's like there was a massive public awareness bell went off, and everyone said, "Why am I getting 0 or 1% of my deposits when I can move into money market funds?" And you saw last year this huge flight of money out of regional banks. And so as a result, these guys with these huge real estate losses, exposures, and meanwhile they don't have the deposits to stay liquid. So they're basically, they have a target on their backs, which makes them a great short sell target. And yeah, you had our friend Cahodes as well as other people of that ilk were shorting these regional banks. And that is why last year they, all of a sudden, we've been yapping about short selling problems in the market for years, and all of a sudden the SEC and they wake up and say, "Oh, we're going to be looking into the short selling of banks." And this was like last April, February, March last year. So finally, they created this pawn shop rule, whatever the official name is, the FDIC a term lending facility, and this is like designed to basically allow the regional banks to get liquidity. So they have all these idiots have been basically borrowing short-term via deposits and then investing in, to get the highest yield, they're investing in 30-year collateralized mortgage bonds. So of course, when rates go up, the duration effect, the price sensitivity is highest on the longer term assets. So, rates going up is bad for bonds. So all these long-term bonds that these banks were buying have taken massive hits, and this is why the FDIC facility was given, so that they don't have to hold these things hoping for a correction, in the next few months. So they basically were able to park those bonds at furl. If they tried to sell them, they would have taken a huge capital loss. So they had to park them in the FDIC pawn shop, and they get 100%, collateral value, which is a joke, and that's subsidized by the taxpayer, by the way. So all these regional banks finally get liquidity, and that allows them to sort of talk to their clients in the commercial real estate business and say, "Okay, guys, here you go. Yeah, you don't have to pay us what you owe right now, but you have to, give us 10% now, and we'll deal with it." So it's been can kicking, as you said. So all that debt that was supposedly coming due last year and this year, it's been can kicked to 26, 27. But it's huge, and now. The Fed is realizing that this facility was a short-term facility, and the idea was that this would be a short-term ailment, and then they would address their asset liability imbalance and be able to get funding. And funnily enough, we saw, like, again, so that but the market is only going to correct on these bonds if they think the Fed is going to cut. So, for all of 2022, there was some sense, well, the Fed is hiking too fast, they're going to have to pivot. In early 2023, it was like the Fed is going to have to pivot. And the Fed kept talking hawkish, and so everyone that thought the Fed was going to pivot in early 2023 got massacred. And, guys like Ken Griffin shorting the Treasury market, they were making a killing. And Bill Ackerman was shorting the 30-year. They were making a killing because everyone that had been betting on a pivot got screwed and had to cover their longs. And so the shorts won. But at this point, it's like, well, you had, I think it was, well, it's definitely November 2022, but in 2023, you had yields, go back in the 10-year go above 5%. It's like, this is going to get ugly. And so, funnily enough, all of a sudden, the hawkish talk from the Fed started tailed off, and all of a sudden, like, oh, maybe we're done. And I know the Bank of Canada in January 2023 said, yeah, we're done. So the Fed sort of didn't say that, but they sort of calmed down on the hawkish talk for a while. And all of a sudden, as 2023 went on, that pivot got repriced in again, despite everyone getting killed before. And then you had, this miracle, like in November or December last year, all of a sudden, oh yeah, the pivot's definitely going to happen. And the Fed, the dot plot's now got 3 cuts priced in for 2024. Oh, And then, in December 2023, Jay Powell says, yeah, okay, yeah, we were thinking about cutting, and so yeah, the dot plot started to indicate that. So all of a sudden, the market terminology changed dramatically, and you have rate cuts priced in. So the value of these bonds that have been underwater at the pawn shop facility are suddenly gaining back value. And they're gaining back a lot of value. The 10-year Treasury fell from from 5% down to 3.80. So that's a huge move in 10 years, and that would just happen in November and December last year. So that is one reason why the Fed is probably saying, yeah, this pawn shop is served its purpose, and the crisis is somewhat over because they've been able to sort of get some recovery on these bonds. But again, there's the problem. It's like you saw two things. Once this recovery in yields happened, and the Fed again was trying to tone down their hawkishness so they could get some kind of recovery on these long-term assets. The issue was that the pawn shop lending rate was based on a 1-year loan. So if you're using this facility, you can borrow up to 1 year. So what would be happening as the 10-year Treasury dropped, or even the entire curve, moved lower. So the 1-year Treasury yield also fell significantly. Meanwhile, the deposits at the Fed are paying Fed funds. So you can borrow from the FDIC if you're a bank, and then not actually do anything with those funds, but put them in the Fed overnight. And so you're making 5.25 or 5.20 at the Fed, and you're borrowing at maybe 4% or maybe 4.5, whatever the 1-year rate was. I don't think it was 4%. I think it was closer to like 4.70 or something. But you're making like 30 or 40 basis points, and basically, it's not risk free because there's a duration issue there. Because if the Fed suddenly if the 1-year Treasury curve suddenly jacked up above overnight, then you would have been screwed. But the fact was that you basically had a basis trade where you were basically investing overnight and borrowing 1 year, and this is a huge arbitrage, and it's no credit risk though. So you're basically, why wouldn't you do it? So everyone started piling into this arbitrage, and as I said, as Treasury rates rallied, as the Treasury bonds rallied in the late fall last year, the rates got higher and higher, and people every week there was a new record pawn shop facility levels. Yeah, no shit, it's easy money. So this is my question: is why the hell didn't the Fed, when they came up with this program in the first place, make sure that the rate would be in line with what the Fed funds was paying? It's like it was an emergency thing, but they waited till November, they waited till December to come up with a solution, or January actually January. So they waited an entire year to fix the pricing on this stupid thing. And why? I mean, you could say, well, they're just stupid, or would they design this thing knowing that banks would take it as arbitrage and help their profitability? So I'm inclined to go 50-50 on this. It's like maybe they didn't realize it, but when it did happen, they weren't too worried about it at first because, okay, well, the banks get some juice and that they'll be happy, and, whatever. And we all know the Fed is actually owned by a consortium of banks anyway. So the fact is, though, that at some point the amounts got kind of ridiculous. It's like this facility is clearly being used as arbitrage, and it's not being used for its original function. So the credibility of the Fed, again, is at risk here. You want to re-extend this program that's currently just being used to make money off the taxpayers? Well, that's not a good look. So again, the Fed had to basically say, yeah, we're not going to extend this program because clearly the banks are just not dependent on it now. It's basically being used for arbitrage, and they couldn't avoid. When people started posting, when people on Twitter and Reddit are posting about, the Fed has been exposed. So that program has to go. But that again, that is an interesting issue because the commercial real estate problem hasn't gone away. It was just kick the can. So if they're getting rid of this pawn shop, what is going to replace it? And as you pointed out, the discount window is there. And this is what boggles my mind. It's like it is all about perception. And people in banking never wanted to use the discount window because the only time the discount window in the past has been used is when there was a bank run. So it's like, oh, someone's using the discount window, they must be in trouble. We better short them. So that's what the Fed is trying to do now, is say, look, stop being so averse to using the discount window. It's there for your liquidity. And instead of creating some bogus pawn shop rule, like use a facility that's already there. And people have said, well, we're still not really wanting to use it. Well, now you're forced to use it. So I mean, yeah, you're basically every bank that wants to participate in the system has to use the discount window, even if they don't need the funds. It's like TARP. Some of the banks in 2008 didn't need TARP, but they were forced to take it. So because it would be bad optics if only the troubled banks took it. So it's kind of comical. But yeah, it's like, so everyone's using the discount window, so therefore you can't really say, cohorts can't say, oh, I'm going to short this bank because they're using the discount window. Yeah.
Well,
If I
that
keep
way,
mentioning that guy's name, it's because I'm still annoyed that he attacked us last year, so I have an issue with that. Anyway.
yeah. Well, yeah.
So
you can't
that
hear
is
me. That's
the-
right. I gotta push my button. Sorry, I gotta push my button for you to hear me on there. I forgot we're in Discord.
Okay.
I
No
just had a
worries.
quick question for you because I did want to ask you a question on this, and I totally forgot about this. But before I forget about this at all, so there's that new rule with the OCC. So I'm going to explain it. I don't know if you've looked into it, but I'm going to explain it to you.
I know the gist of it, but yeah, go ahead.
Okay, so a lot of people went crazy and they thought they were recalculating the margin requirements, and that's not what's happening. But what is happening is the OCC has a global setting already built into it's like SNAR or whatever their management system is. And during the meme stock, just to show you how big of a deal it is, during the meme stock, it went from standard settings to global settings, and it saved them $20 billion from additional margin collateral requirements. Well, what this new thing does is right now, currently, the OCC basically has free reins, right? They can just implement this global settings as they see fit. There's no standards. There's nothing in the computer that will trigger it. It's just they turn it on. It's up to them. Well, in the past, it's only been used like three times, but it has been used during the meme stock settings, and they admitted it. And like I said, I even showed it on the thing. They broke it down, and during that time, it saved them $20 billion. Well, what this new bill does is the banks want, and I don't know if this is good or bad, what the banks want is the OCC to not have control on when they just do it. They want a standard auto-implemented setting that will just trigger during these specific things. I think that if that gets implemented, that's bad for us because they will, then they'll know the edge they can teeter on. They're going to live more dangerously. And on top of that, they know that trigger will get set automatically and there's nothing anyone can do about it. What are your thoughts on that?
Yeah, I mean, from a basically a risk management perspective, I would want something that's like predictable. So as a bank risk manager, I would say, yeah, we don't like this arbitrarily determined speed bump or whatever the case that could be implemented but may not be implemented. We don't know. So as a bank, you would want to say we want to know. But then once you have that limit in place, yeah, then it's like it's being able to be gamed. So I just think back to like with the Robinhood, margin call from the DTCC. It's like, you call them up and say you owe 3 billion, and for today, and all of a sudden it's like, well, there's no way they're going to get 3 billion, but we'll give them 2 billion or 1.8 or whatever Robinhood came up with. And it's like, but that was again a completely arbitrary thing. It's like, well, how does 3 billion become one? If you really wanted 3 billion, now you only want 1.8. So that's like, again, it's like when someone tells you got to pay like what are your mortgage payment tomorrow, and if you don't make it, you're going to be sued or whatever. And I was like, well, I made half my payment. Okay, we won't sue you. It's like there's got to be some kind of consistency there. But yeah, like now, once you know what your limits are, it's like, yeah, they can basically say, well, we can trade around this and not worry about the OCC screwing us up with a surprise. I guess a better thing is when Chancellor Zern and the AMC, she was a bit of a wild card. It's like, well, we like to know exactly how she's going to rule, and so she's removed as a wild card, and we know exactly what the timing and the ruling is going to be. It's easier to screw around with the price. So I think that's sort of how I view it is. And the other thing I guess I would view is like, the biggest problem with the meme stock plays is the fact that you had the gamma problem. And even what the stupid Interactive Brokers CEO, in that famous interview said that the system was in danger of blowing up because of GameStop, and that was basically because of the gamma exposure. Because it's unknown, like it was like once you have like, here's my thinking is like they've been everything has been gravitating towards more and more option trading, and we can see that in sort of the daily nonsense in AMC prices, but also like on the main indexes. You've gone from like weekly option expiries to daily option expiries, so a lot of volatility is being created by just huge option trading. So I think in some sense you do not want the OCC being a surprise. So yeah, like if you're going to be trading huge amounts of liquidity and leverage in your option positions, you want to have as much certainty as possible. But yeah, like insofar as making that optionality exposure easy to manage, it will limit the kind of MOAS potential, because again, you won't be as likely to get caught flat-footed. So
That's what
that's
I
sort of
was.
my view. Is yeah, like to me, people ask, "Who's going to kill MOAS?" And I said it certainly reduces a MOAS due to gamma. But whether it like the overall problem is that there's been so much fake created relative to the actual floats. So how that resolved is a different story. But like the option side of it, like the Mudrick getting caught selling AMC calls in June 2021, well, they may not be so worried about covering all their exposure as they did, if they have a better sense of how the risk parameters are. So that's my sense is basically trying to make things more transparent for the banks, and that allows them to manage their options better, which will basically limit the potential for surprises on the option side, and that's not necessarily good if you wanted a technical squeeze.
No, I agree. That's what I was always saying. It stops the MOAS because it'll automatically trigger and they'll automatically get bailed out, and they'll know that that's going to get triggered off, and they can go ahead and do the manage like these calculations on what they'll get bailed out with and how far they can stretch just that little extra.
Yeah, yeah. As I said, it's just like if you look back, what happened with like June 2021, Mudrick was stupidly selling, like we were down around $11-12, and they were selling June $35 calls, and they just sold a lot of them, and then there was so much FOMO buying of those options that the risk management board at Mudrick basically told Mudrick to go cover those call option exposures. So this is stupid thing is AMC actually gave him like 20 million shares the day before, and instead of using those 20 million to cover that, he basically sold those shares and said AMC's a dog. And then the next day, his board said, these calls are a problem. You got to cover them. So, but that's why we sort of saw that move from like 35 up to 60. And the gamma exposure that like everyone else had been selling calls suddenly panicked because they hit the exposure. And so that was the thing. If like everyone knew that their gamma exposures would be taken care of and they would only lose a certain amount, then yeah, that would limit the panic covering that we saw. So it's a concern. Again, I haven't delved deeply into the regulations, but that's my sense is they're just trying to, because I do think that option positions are even bigger than they were 2 or 3 years ago. And my sense is that and again, this is hard to prove in any sense, but there is a Fed office in Chicago that basically plays on the futures. And I've been, if you look at the VIX, and how do you explain with all these black swan events that the VIX keeps getting lower and lower? And I just suspect that the Fed has been selling index calls and reducing volatility. And they've probably been doing that because option players have been basically, being a lot more aggressive in their option position. So VIX has to be lower to not create a panic of, oh my God, our VIX exposure is so huge, we're going to blow up if this thing goes up. So if the VIX went up like to 30 or 35 again, it would be hell. So I think this is one way of counteracting that trend. That the Fed cannot be, plunge protection team cannot be, suppressing vol forever, right? So that's my conspiracy theory.
Well, and then on that note, I mean, I can go ahead and skip down to this next thing I was going to ask you later, but I mean, kind of goes into this. So it says U.S. lenders debt to shadow banks like hedge funds and things like that, financial companies now past $1 trillion. What are your thoughts on that?
Exactly. And the shadow banking issue is huge because they are overtaking, the banks and the brokers in a lot of ways. And if you look at the reverse repo account, and it got expanded and who could use it because of the shadow banking issue, it's like wasn't the banks that necessarily had all the liquidity. It was all the money flowing, like all these funds were getting cheap money and they had to basically park it. And so like and they basically wanted the collateral that the Treasury would give in the reverse repo. So the Fed just kept expanding the number of people that could use the program. But you can also see this in what was recently announced by the Fed. It's like, if you want to trade the Treasury market and you're an active, especially if you're Citadel or whatever, and you've been shorting the crap out of it, well, your volumes are now bigger than a lot of other of the dealers. So you really should be classified as a dealer as opposed to some non-entity. So what that means now is they have to provide more documentation of what they're up to to the Fed and to the Treasury, so they know, the Treasury needs to know because they're trying to figure out what Treasury terms they should issue their bonds. And if if there's a lot of demand for short-term bonds and they can issue cheaper short-term, then that's stuff they need to know. But it it really comes down to there's the shadow banking has created massive activity and it's not being tracked properly. So that's why the Fed wants to basically put Citadel and these other guys as registered dealers, which means they have to provide more information on their positions, which means that the size, if you look at some of this, who knows what the size of Citadel's fixed income treasury short was. So I think that's the concern for authorities, is like we have, we're so we have to issue so much debt in the next few years to refinance everything that's been issued, and we don't have a clue who's shorting this thing. So if we think that we need to issue 10-year, and we'd rather not issue it at 5%, we'd issue it 4%. But who's the one that's shorting it? Why, what kind of short positions are there? Are they creating a distortion in the pricing? Are they costing the American taxpayer? Because it's one thing to lock in 5% in a 1-year bond, but if you're locking in 5% on a 10-year, that's again, it's like if you think rates are going lower because the Fed may eventually cut rates, then you will probably want to delay issuing 10 years. But it really depends on what the market participants are doing. And if the entire yield curve movements are being distorted by large speculative positions, either long or short, you need to know who that is. And so I think that's a big problem. The shadow banking has gotten so big that it's outweighing what's actually going on with the non-shadow, like with the regular banking sector. The activity in the shadow banking is too big and too influential. It has to be regulated. It has to be examined. And yeah, like the debt exposure from like the lend. I've been saying this. We've been saying this. It's just there's too much debt that was issued in the last few years, and the hedge funds have basically been going crazy with it. And then this will probably lead into another question: is like, well, how the hell are they maintaining all this debt? Well, they need collateral, and well, they've been dumping money, pumping into the big seven. So, Nvidia is insane, and there's guys on the internet that are like Mr. Nobody on Twitter is basically pointing out that CoreWeave is basically been taking money from hedge funds and then buying chips and storing the chips. And so, you get this like inflated demand going on. And why are they doing this? Is because they've got all these leverage positions in the shadow banking side, and they need collateral to justify them, or to basically, say that we've got the collateral to offset these debt. So anyway, it is a big mess.
No, and I agree. And I mean, that was one of my questions too going into it, was for the setting the label on the hedge funds for the dealers. I was going to ask you if it was more about what you just went over, or was it a way for the feds now, because they can now directly buy treasuries for them if they get that dealership? Would that be a way that the feds could also technically bail out the hedge funds?
Yeah, I mean, it certainly is a case. Well, basically, if you're a dealer, it allows you access to treasury auctions, which means that now instead of having to go, Citadel doesn't have to go through Morgan Stanley or whoever like if you notice some of those DTC announcements where there was like so and so is cutting off their account, it's like, oh, the Citadel's leaving no, they're just not, they don't need a middleman anymore. They're going to do it directly. So in a sense that they're trying to be, if you're doing a few $1 billion of trading a year, then you're paying a commission every time you go through Morgan Stanley. So you're basically, if you're going to be a very active participant in the treasury market, it would make sense to be able to access auctions directly. So that's what it's all about. Is like, yeah, there's a benefit for them. There's also a cost because now the Fed has more information on what you're up to. And one of the biggest like if you go back to like the 1990, again, I'm being Putin here, but so Solomon Brothers was a big dominant firm in the U.S. Treasury market in the 80s, and there was an arrogance there, and what would happen would be that they would try and corner the Treasury market at the auction, and they lied about who their bidders were, and so that was because they had to provide information. It was at some point it was easy for the Fed to see who they were actually misleading the Fed as to who they didn't have the people buying the treasuries they actually said they did. But someone like Citadel, now if they were doing sort of buying an issue but through 5 or 6 different counterparties, now they have to do it directly. Well, now the Fed can see, you will basically have more information on what they're up to. So it'll be a little harder for them to play games, but it will give them liquidity. And it'll bypass commission costs. So there's pros and cons for them.
Yeah, of course. There's always little ways to bail them out in the end of the day. But I just wanted to get your thoughts on that because you were talking about like the Feds and their credibility, and I was like, well, now they're going to end up. There's always that one where they can bail these guys out a little bit, but I don't believe it'd be to the point where obviously when these guys are at over $1 trillion in loans, that's not enough for these treasuries are going to be able to bail them out of any means if they get recalled. Just so people understand that though too as well.
Yeah, exactly. There's limits to, like I said, it's not quite as bad as like as long as the public doesn't realize they'll let them banks get away with hell. But it kind of is. I mean, it's like there's a certain. It's like oh, it's complicated. Don't worry about it. Well, public doesn't need to really understand this, but the public is very when this Fed's credibility is under spotlight as it is. I think it's a little less easy for them to do like a something like a TARP now would have a lot more scrutiny. So I think any kind of bailout has to be put in that context. It's like, yeah, we have to be able to really justify this as opposed to just willy-nilly saying, yeah, what's good for the financial system is good for the economy, because there's a lot of skeptics now basically saying, yeah, what's good for the banks is not good for everyone else. And I think that's an issue, is like the Fed's credibility has been shot, and so they have to be a bit more judicious about the programs they come up with. And that's why, again, this pawn shop rule, when they're fucking urbing it to death, like, yeah, we can't really extend this. So I think that's one thing the Fed is under pressure now, is any kind of bailout has to be, it can't be as ad hoc as it was in the past, that's for sure.
Yeah, and speaking of them, we'll get into Powell in a second here, but I don't know if you saw that interview with Janet Yellen, but they asked him about, do you think prices need to be lowered? Things are up 20-30% across the board. I showed everybody over and over the consumer price index. It's at all-time high, and it's jumped up. And one of the things Yellen says is we don't have to. Well, one of the things he talks about is how you need to have deflation. You need to get into a recession in order for this prices to go down. And it's like one of the things I always say too is or what you can also do is create competition, which the problem with the United States also is you have so many of these corporations, nobody's starting up new companies, a lot of them are going out of business, less and less competition, so there's less and less deals. These guys can get away with charging a little bit more, so it's like you don't have to always have all these bad things to have go into place where no one can afford anything. That's just what I feel like they always teach you, when it's like you can also just open up more things. Competition, the way they could do that would be to lower rates. But what are your thoughts here on them saying they don't need to really worry about prices because wages have gone up, and if you look, it's only gone up like 2%. Nobody got up anything that they need to get to.
I mean, that's it. It's like, well, Yellen is, and I have a personal bias here. I personally think she's one of the worst Fed Reserve chair people that has ever existed, and as a Treasury Secretary, she's even worse. The fact is that Citadel paid her $100,000 for speaking fees. Also doesn't ring well with me. But yeah, I find her very lacking, and I try not to be too political, but it's harder. It really is hard because the Biden administration has people like Yellen representing them, and that really does not instill a lot of confidence in me. So Yellen, I don't have a lot of faith in any of her cognitive abilities whatsoever, and the fact that she was able to be head of the Federal Reserve, doing a crappy job, it's like it just boggles my mind. But anyway, what she's saying is not necessarily true because, as you noted, um, it really has become a situation where you have oligarchies or even monopolies in many industries. And there's a Fed Competition Bureau, and there's you look at something like, well, we've got to break up Google, we've got to break up Microsoft because they're too big. And so there is a sense of like, oh, well, it's gotten too obvious. But on a more micro front, like things like Amazon buying up Whole Foods and things, it's like, yeah, like it really comes down to the banks. Again, if the regional banks go under, and I don't know if this is going to seep into the other question, but yeah, like the regional banks have been sort of a provider of credit to smaller entities. Now, if all you got are Citibanks and JP Morgans, their bias is to lend towards big companies, not so much, innovators. And so the innovators are reduced to going to venture capitalists or private equity, and it's not always advantageous for them to do that. And then you get the situation where, so many of the stories we've heard about where a small guy gets financing from a dubious company who then winds up, getting them public and then shorts them to death and they go out to bankrupt. So, there's definitely a stifling of innovation because there's not a lot of good um, opportunities for smaller lenders to create competition. So you have I I call it gentrified. I don't know if that's the right word, but it's a stagnant thing where, yeah, if you're not big, you can't get a good loan to start a new business, and so you can't provide adequate competition to a firm that's already there, and the firm that's already there may have once been a great company, but now is, I mean, I'm not going to use McDonald's. That's not a good analogy because fast food is still, there's a lot of competition in fast food. Whether it's good or not, it's not, but um, yeah, like a lot of industries, there is only one or two providers, and there may be five or six firms in the field, but they're all like interrelated. Sort of like in Korea where they call chaebols, where there's basically six or seven companies that run the country, and so that's the sense in the U.S. It's getting that way. So yeah, like there's not enough innovation and competition to stimulate activity in the U.S. and you don't have enough mom and pops going, and that's if I was running things in Washington, I would look to ways to unlock that and stimulate activity in the smaller business sector. And that's always a pipe dream for politicians. They say that, but really it is obvious based on what's happened in. God, okay, I'm just going to go off topic here. So I've just finished a show called Continuum, which aired Sci-Fi channels back in 2012 to 2015. And it's all about corporations running the world, and time travelers trying to go back in the past and change that. But it's sick because yeah, these companies basically have so much power, and I said the chaebols in Korea have been like that for decades. So much power concentrated in so few company hands. It's like sort of what we're seeing in the wealth effect, where you got the 1%, and the 99% others. But the 1% of and it's even gotten worse in the last few years because now you have like Super Seven and then S&P dominating everything else. Seven companies dictating gains, and so anyway, getting back to Yellen, certainly wages have not kept up with inflation, and the problem is that inflation is being the official inflation statistics are being massaged. I don't see people getting 10% raises. My in Canadian inflation is, was, during 2022 was up at 8%. My raise was like 3%. And so this year I'm getting a 3% raise, but inflation's more than 3%. So, wages are rising, which is a justification for the central banks to not cut rates. But relative to cost, yeah, it's not keeping track. We're all suffering, and that's not even talking about something like shrinkflation, where that bag of chips that you bought for $2, well now you're paying 250, but it's like one, 2/3 the size it used to be, and that shrinkflation I don't think gets captured very well in terms of inflation data. So we're getting screwed right, left, and center. Uh, and yeah, like you got people like Yellen basically talking BS. And Yellen, of course, is the one that said inflation's transitory. Or no, so that was Jay Powell, but Yellen backed that up. And then even when Jay Powell started to talk nervously about inflation, Janet said, don't worry, it's all under control. So, again, I don't have a lot of respect for her, whatever she says. And I really hope, even if Biden, well, I don't know what's going to happen with the election. I cannot predict the U.S. election. I wonder if Biden's going to be around, but even if he isn't, I would hope that they come up with a new Treasury Secretary. If I had one wish of anything, is like I do not want Janet Yellen to be Treasury Secretary any longer. God forbid, don't shoot me for saying this. I prefer Ken Griffin as Treasury Secretary over Janet Yellen. So there you
Yeah, and that's exactly how the interview starts out. He goes, "I guess this is now here to stay, so I guess it's not transitory."
go.
But the next thing
Anyway,
here I wanted to get into is we talked a little bit about the commercial real estate. I feel like you have 518 billion set to renew. A lot of it's been holding on by these regional smaller banks, and a lot of them you're seeing are taking 50, 60, 70%. In a case last week, I posted 80% discounts. So this is going to be a huge bomb. I think this will be, a lot of people are talking about Evergrande, but we don't have that 500 billion is not exposed to us, but this
yeah.
hundreds of billions is exposed in the United States. So, what are your thoughts coming on? What's his name? Powell just said that he expects smaller and middle banks to close down and merge this year. Do you agree with
Yeah.
that, or do you think they'll be able to get out of that?
Yeah, no, they can't get out of it because this is the whole thing. Is like the only thing that would save them is if they cut rates back to zero, and even then, it's doubtful that everything would be right. So, um, and the only issue that is different from China. So yeah, China basically commercial property was not. It was residential property in China, but it was a big problem. But most of it was held by in within the country, and because the Chinese government basically runs most of the state banks, it was all basically manageable. They can basically keep these zombie banks in China going with extra liquidity, and you think the Fed is guilty of subsidizing the banks. Well, the Chinese government completely props up their banking sector. But in the U.S., like you've seen it with banks. Like there was a Japanese bank that fell like 30%, and Japanese insurers were taking a hit the next day. And then you had, I think, Paribas in France, or there was a German bank that just collapsed 40% in share price. It's all because of commercial real estate exposure in the U.S. Oh, then it's not just the U.S. So Julius Baer, their CEO, resigned because of a $600 million hit to the real estate sector because they were lending some property developer in Germany, or was it Hungary? I can't remember. But anyway, the fact is, this commercial real estate is not just confined to the U.S. Even if it's U.S. related, the institutions that have invested in it are not just U.S. regional banks. It's also smaller foreign banks such as Paribas or whoever the Japanese bank was. So it is a big problem, and I think you referenced the article, like how many $1 trillion are coming due in 2027. Uh, it'll be a huge bomb, and again, maybe they can kick some of it down the road, but how much it's said all these stories on X about this property sold for 220 million, now it's valued at 80 million. It's like everyone that has a loan, the banks that made that loan have basically got to look at, well, that building just got written down. We have a loan to a guy who owns a similar building in the same city. Can we justify this thing actually still being worth 200 million? It's probably not worth more than 100, and we've got to basically figure out if we want to keep a loan with this guy. But oh well, we can try and foreclose and take the building, but then we're going to take a capital loss. So there's all kinds of messes here, and it's going to be borne by banks and investors of banks. And yeah, like 2023 was a prelude to what's happening. And as you pointed out, it's like this was a god. Like first of all, it was a short selling frenzy for Cahoes and all those guys that were jumping onto these regional banks that did get bought out. They until the SEC said, "Oh, we're going to look into the short selling and be very careful," and all of a sudden, all the short selling stopped. So when the SEC decides to actually say something, then okay, then but yeah, like it's very interesting how it was confined to just that example of the regional banks were being shorted to death, and it was basically exaggerating the existing problem. But there's going to be more of that, and we saw 2023. We saw J.P. Morgan snap up a few banks, one bank in particular. I can't remember the name right now, but the issue is, yeah, like these, J.P. Morgan already had too many deposits they were over their deposit limit when they took over that other bank. Now they made even more over their limit. Like it's 10%, 10% of total deposits. I think JP Morgan now has like 14 or 15%. I can't remember, but it's huge. So can you expect that JP Morgan or BOA are going to buy all these regional banks? Maybe they'd like to, but I don't think that would be allowed because you have a too big to fail problem already. And do you want to exaggerate that even more? And a lot of these regional banks have complete garbage on their balance sheet, so maybe they should be told to fail. And again, it's like the FDIC ripped up the balance, like ripped up the rule book with Silicon Valley Bank. So, the can you expect them to go and just adhere to that whatever $250,000 deposit limit when these banks fail, or do they try and make depositors whole on some of these other failed banks? And what does that mean in terms of how they're going to fund that? And it's just a big can of worms. So they can't keep kicking the can because this is just going to get bigger and bigger problem. The interest rates are not going to go down because the Fed's worried about their credibility, but they will have to go down eventually. And I think the dot plot is still showing 3 cuts. And oh yeah, you probably meant to ask me this earlier. So initially back in back in December and January, early expectations were a rate cut in March. That has now been pushed back to June. And there's still about 3 or 4 cuts expected in 2024, but the timing has now been pushed back. And I think people were highlighting March as possible a start date because the FDIC pawn shop was being canceled in March. And so I think the people thought, well, the liquidity will need to be provided. There needs to be a sense of something happening soon. Otherwise, with high rates, the regional bank problem will get bigger and bigger. And because the Fed has pushed back on the March cuts, that's when you started to see these headlines about, Japan Bank loses 30% overnight on regional bank exposure to the U.S. So yeah, this is going to be a big problem, and it's going to not go away for the next 3 or 4 years because of that huge amount of loans that need to be refinanced by 2027. So it might not be so bad this year, but it'll get worse next year, and it'll get even worse in 2026 and 2027.
Well, in
So
2027, up to that, it's supposed to be 2.2 trillion set to be renewed. In 2028, it's going to be it's supposed to be 3.3 trillion. So another trillion alone is in 2028.
Yeah. So how do you kick the can of that? You need rates to go lower. So I do expect the Fed Reserve to cut rates, Canada to cut rates this year. I expect them to start in June. They would probably like to do it earlier, but the data again has not been supportive of it. The data has been positive, and the data has been positive because both governments seem to be inclined to some reason, want more and more people to come into their countries. And again, you could try not to stop politics, but it does seem to me like maybe this is voter acquisition. It's like in Canada's case, I know that's exactly what they're calling it. It's like we had 1.2 million people join the country last year, and traditionally the Liberal government tends to be a beneficiary of immigration. So, the Liberal government is trying to avoid getting turfed out. So bringing in more people into the country is maybe helpful for them to stay in power. And there's talk in Biden administration is doing the same thing. I was going to make a tasteless joke about wanting to go take a vacation in the U.S. and get it free, and basically all I had to do was say I'd vote for Biden. I mean, but that's the sense I'm getting from things. It's like that's what some allegations have been, is like the Biden administration is trying to buy votes through immigration. So whether that's true or not, it's certainly creating this demand issue, which is causing the Fed to be unable to cut rates. And so you have people that are struggling with dealing with all these high interest rates, and the regional banks being one of them. And so you'll have a regional bank collapse, but the Fed can't really do anything on the interest rate side because of the immigration side. So as I said, when I started this whole talk this morning, I said it's a very complex thing with a multi optimization issue. There's multiple issues that conflict with each other, and that's where we're at. So yeah, the regional bank problem is huge, and it's not going away, and it will impact stock prices. And just a question of which banks get nuked and how does it get wound up. And I don't have a clue how it's going to be messy though.
Yeah, and I mean, right now, just to try to help them bail them out, and this is the thing, like they want to try and take 50. They want to try and make a startup program to buy $50 billion worth of real estate commercial real estate, but with government assistance. But it's like even if you do that, they're still going to take a hit on all these buildings. It might not be a 80%, but it's still going to be a 50%. You know what I mean? And in the end of the day, you're still passing that around towards like there's no way you can pass that much because you're starting to talk trillions and trillions. But one of the things that they said was the United States has more banks than any other country, compared to their amount of currency printed. So we definitely don't need as many banks as there are. And eventually that, they're going to start weaning it out. But this all leads into like the next thing I've been saying forever. And it's kind of weird and crazy to think where the United States is heading towards, because I've been saying forever we're in a financial debt, a debt spiral, and it's nobody seems to really care. We keep spending, doing all this, but the problem is it's now not going to allow you to. Everything's kind of screwed up to where, like we said, everything's been kicked so far. Where you can't really ever really lower those rates. Maybe down the road, but I don't think they're coming anytime soon. But what was I just saying? Sorry, I lost my train of thought there.
No, yeah. Here's the flip side.
Oh wait, no, I'm sorry. I'll go back to the bank spiral. I'm sorry, but here you go. Sorry, but my question was: so in the end of the day, the entire United States banking system was set on everybody having their money in the banks, everybody putting their money over here. But eventually, over time, like everything else, we start evolving, and then you look at to me, the money market funds you can see trillions are moving over there. Broke 6 trillion. They said another 1.5 trillion is set to leave the banking system and go over to money market funds again. So I look over and see this as being a bigger problem, than they're letting on, because not only are you having this commercial real estate crisis going on, you're having people leave deposits deposits leaving by the trillions a year.
Yeah.
So one of the things I say, what my question was is, Powell said that we're not on a physical path that is sustainable. They're borrowing from future generations now just to get by today. What do you see happening in the United States if this little bank running? Do you see it as actually being manageable, or do you see this as being something that could be a catastrophic type event?
Yeah, well, I don't. Yeah. So you pointed out, like, the commercial real estate crisis is not. It's not manageable. It's been kicked, and the deposits keep leaving, and that's one reason I do believe that the Fed is inclined to cut rates. Is to again, that's why people thought the cuts would start in March, because if the regional banks have diminishing liquidity because deposits keep leaving because rates are high, well, the solution to that is to cut rates. So if the other solution is for the regional banks to actually offer competitive deposit rates, but God forbid that would kill their profitability. So it's a huge mess, and yeah, the debt itself, and that we've talked about this before, but I keep talking. It's like if the if the U.S. debt is 34 trillion now, and this is what I was going back at the very start when I was talking about Volcker and raising rates to 18%. You cannot do that now. The Fed is raised to 5 and a bit, and you cannot see like a 10-year at 8 or 9%, because that locks in a huge financing cost, because your debt now is so much bigger than it was in 1971. So, or 19 whatever, when Volcker started hiking, 1975 or whatever, 78 I think. Anyway, the fact is the debt from the 70s was so inconsequential compared to what the debt is now. So you cannot have the Treasury locking in extremely high rates on their longer term duration assets. So you need rates to come down in order to service this federal debt, because right now the amount of debt, the amount of on the federal Treasury's revenues, the amount of the revenues that are needed to service the debt is ridiculous. I think it's over 50% now. So any money that's spent servicing the debt means that you can't do Medicare, or you can't do old age security, or you can't do defense. And so, well, how do you get around that? Well, we'll just have to borrow more. And so you create more debt to maintain your military spending, because God forbid we got to, and that's another topic altogether. But So it's impossible for the Treasury to be able to be comfortable with longer term rates staying where they are. So the rates have to come down because otherwise, how is the U.S. going to finance its debt? And the rates coming down will also help smooth the problems in the regional bank sector. And the fact that Powell actually said things to the explicit sense that yeah, like we have an unsustainable debt problem. Yeah, no shit. I mean, someone like myself has been posting this on LinkedIn since 2018. I said there's too much debt. There's not enough productivity. There's no way you can longer term have this much debt created without a productivity increase. And if you get a huge AI boost, and that's why people haven't been panicking because they wave it off. They say people feel like you're just worrying too much. It's like AI will take care of everything. It's like AI will be super productive and it'll make these jobs redundant and we'll have so much productivity. Well, okay, I'll believe it when I see it. And you've got Elon and all these other guys hyping about how the world is going to be magically more productive. And okay, I'm not a tech guru, so I'm going to sort of look at that. But in the meantime, the debts keep getting bigger and bigger and bigger, and the interest rates are too high. So you're gonna have a problem, and the only way of not having a problem is to what they call monetize the debt, which means printing money, which means inflation. So yeah, like how is the Fed going to get around this? They either have to basically say that yeah, we're going to change our inflation targets. We don't have an inflation target, but we're going to tolerate 3%. We're going to tolerate 4%. It's okay. Don't worry, guys. It'll be transitory. Trust us. But the global economy, they're going to have basically money printed because there's too much debt. It has to be monetized away. It has to be inflated away until this AI productivity miracle happens. In that case, maybe we do worry about deflation, but in the meantime, there's just too much debt. It has to be printed off. And that means the US dollar is going to probably lose its value to some extent because, yeah, like 34 trillion, when it's 35 trillion hitting us. And yeah, and I'm in no way a fan of Russia or China, but the alternative trading pact that the BRICS is creating is going to exert pressure on the US dollar at some point, and it will basically weaken the dollar. It's just a question of time. It's not like it's going to happen tomorrow, but it's a trend that's hard to ignore. And there's a lot of guys that say, "Oh, you're overhyping. The BRICS is never going to be competitive with the U.S. dollar." Maybe not. It may not be that capital markets flow to Shanghai. It may be that it only takes 20% of global activity, but that's 20% more than it currently has, right? So there's going to be a significant weakening in the dollar. It's regardless of whether you believe BRICS is a reality or not. There is impetus to do transactions in anything but dollars, whether it's Bitcoin or whether it's gold or whether it's a renminbi based swap with gold, whatever it is, it's going to be not dollars. And the fact is that the U.S. monetized the dollar when they took Russia's foreign exchange reserves, and everyone saw that. And people do not understand what a big mistake that was. Uh, you've got guys named like Jim Rickards basically pointing it out. It's like this is the biggest policy mistake the Biden administration has made. It's like you have basically deterred any country that has any concerns about having a uh, strife with the U.S. is, oh, we'll have our reserves confiscated. So we should not have our reserves in dollars. We need to find an alternative so that if we have a problem with the U.S., they won't immediately confiscate our money. So longer term, it'll be a big deterrent to using dollars, and that'll undermine the currency. And the U.S. strength of the dollar is basically been one of the dominant strengths of the U.S. It's just hard to understate it. It really was a boneheaded move. I can understand why they did it, but then there's talk about there was legislation going on in Congress. So we'll take that money that we seized from Russia and we'll give it to Ukraine. No, so we don't have to worry about another spending bill. We'll just use the money we already took from Russia. That would be even worse. That would be like, okay, you not only did you freeze Russia's money, but you're never going to give it back, and you gave it to their enemy. It's like it politicized the dollar to the extent that it's just not good for the longer term confidence in wanting to use the U.S. as a currency. So anyway, that is all entwined in the inflation problem and the debt problem. So.
Well, then it's going to be pretty much impossible to raise rates on the treasuries because lower them because you're going, you already have less demand from other countries.
Yeah.
What happens if they sell it off and now your debt's growing, which means it's getting riskier and riskier, which means you're going to have to offer more, which means the banks are
Yeah.
never going to be able to keep up.
Yeah, no, exactly. So that's it. It's like, so you need lower rates to save your regional banking sector and your banks in general. But if you lower rates, then that's less attractive to buy treasuries. But you need the lower rates because you have too much debt and you can't service the 10-year debt at that level anyway. That's
And
why
you're
the
still
treasuries are
spending
fun.
even harder than you were spending before, so you need that.
Yeah, so you need to be able to issue debt. You need people to want to buy your debt. So, but you can't keep like issuing this debt at the current rates because it's too expensive longer term. So like the ultimate, what has to break is the dollar because like if you want people to buy your debt, it has to be cheaper to buy that debt in foreign currency terms. So you need a dollar devaluation. If you're not going to let rates go up because you can't because your banking sector and your fiscal treasury needs lower rates, then you're going to have to suffer a hit on the dollar. And that longer term, that's a deterrent to U.S. strength and U.S. economy. But it's really the only option I see is a devaluation of the dollar.
Well, we also got to think too. There's 8.2 trillion set to be renewed at the end of the year in the Treasury. So if that's not,
Yeah.
then what?
Well, it has to. It will get renewed because they have to fund it. It's just what rates they're going to fund it at, and whether if they do lock it in at if they do, they're trying to shift as much issuance into the short term as they can. But again, that's kicking the can because eventually you'll have too much maturing in the short end. You'll have treasury auction fails. You already saw one last year in the 30-year, right? So people didn't want to buy 30-year debt at such a crappy. They needed a higher rate. So the Treasury didn't want to pay that higher rate. And that's the problem. It's like, well, even in the short end, if you're trying to issue too much Treasury at the short end, at some point the rate will have to be much higher. And yeah, it just really is ugly. And I remember the last call I did with you. I said, look, I hate to be so negative, but it really is ugly, and it hasn't got better. So,
No, it's gotten way worse. And that's the thing, and that's the thing with the banks, and that's why I keep saying the system, to me, could be on a course to a catastrophic fail. Because no matter what, after what we just went through with the money market funds, the rates, the treasuries I think they're just going to go up. They have no choice. We can't stop spending. We're greedy. We're not going to, pay it down. We're just going to keep doing the same thing. Well, don't worry about it. Then we'll print off some more. Inflation will come back again. And eventually they'll do a stimulus or something to calm people down for a minute. But, anything to get by. But that's the problem is banks will never be able to keep up. More and more, if you have another 1.2 trillion that's set to leave this year, 1.5 trillion that's set to leave this year, well, more people are going to keep catching on, and it's going to eventually make banks pointless other than to just pay your bills. You'll just have enough in there to pay your bills because you're not going to, with inflation, because they're going to print again, which means inflation will go up again, which means just by having your money sit in a bank at 0.5%, you're losing and losing and losing money on that. So the only way to keep up is to move it into a money market fund. But if that happens, our entire financial system relies on all these banks. So it's going to get very, very interesting.
That's a great point. And I was just going to say, like, I was trashing Yellen and the Biden administration, but to be honest, whoever wins in November, it doesn't matter who the Treasury Secretary is. This is a huge problem that's not easily fixable. It doesn't matter who wins. So I've been pushing RFK posts because I think it'd be interesting to have a third party candidate in what they'll do with the election. And I think he's all over the map in terms of his policies. But even if he gets in, it's like there's not going to be a magic bullet. There's no like screw Wall Street, drain the swamp. It doesn't matter if the swamp gets drained. The problem is so big right now. It'll take like decades to fix. It's that kind of problem. Unless there's some productivity miracle, if Elon Musk can deliver, whatever, this magic bullet of like everything gets cheaper to produce because computers can do it much faster, and you guys can just sit and just watch the computers do it all for you. We'll see.
Yeah, it's Definitely, this is what I mean. Right away last year, I was saying next year you're going to see in January, February, you're going to see massive job cuts. That Market Watch put over. They had their record job cuts in January ever recorded, and then after that, I got a banking crisis going. I feel like this will be the year of the apes because I know a lot of
Yeah.
people are like, yeah, we hear that every year, but it's like they've kicked this, like I said, they've kicked these cans with all of this point to where the mountain's so big, it's by trillions, and you have deficits by trillions in everywhere. The government is losing money up, everywhere they turn. They just printed 16 trillion like 3 years ago. Where did it all go? It's all gone. They don't put it
Yeah.
into the country or the economy or make it anything better. And eventually, like we said, eventually that's going to come knocking on your door. And I don't see how they can get away with all this stuff this year. I don't know unless they come up with some more miracle programs, but I don't even know if they could save it at this level.
Yeah, and I mean, in terms of our play and stuff or our plays, I mean, there is, you're going to ask me about T+1, and I do think like it's long overdue. And will it matter? I think this is like the SEC is slowly inching its way. Like I said, trying to get Citadel to be a dealer. It's very gradual. Like it's not helping from what our perspective. If you wanted to squeeze in 6 months, it's like I can't tell you this. This is the catalyst that'll finally do it. All I can say is it is creating an environment where it's harder and harder to get away with the shit that's happened until they find a new loophole. And that's why I'm sort of the focus on Brett Harrison and tokens and stuff is in my view it has to happen because that's their escape route is crypto, I believe. And I think there's been so much nonsense that's gone on in crypto and how it's influenced stock prices. It's impossible to guess. But the SEC has tried to make its mark on the crypto sphere and took out the Department of Justice went after FTX. But there's a lot of unknowns still there. But I mean, at least on the normal side, it's like T+1 is probably 20 years overdue, but here we are. And getting more transparency in terms of revealing short positions until they transferred all to Europe, where Europe doesn't seem to care. I mean, that's another issue. So like the one revelation for me through the last few years is like all these rules I thought that would be effective have been half effective or been circumvented by just the shoddy overall global framework. And so yeah, like cats is huge for me, and I know this is one of your questions, so I'll talk about it now. I have always thought that cats was like the bullet for this play. Like you wanted the shorts to be accountable. Well, cats would have done it, but it kept getting delayed, and that's like, oh well, now like Citadel was suing the SEC because the SEC was saying, well, you've got to pay for it. And it's like, why should we pay for something that like that polices us? Like, well, why does the taxpayer have to pay money for the police? It's like, come on, Citadel, you're just frightened about being exposed, and all these other, Dougie Sifu, he's been strangely quiet lately. But yeah, I mean, this is the issue: is like cats will basically be a big constraint on their activities, and so that plus T+1, it's all going to eventually happen, but just not at the pace that we want, and it's just so frustratingly slow. And it's like that's just like I really stopped looking at this is the catalyst because whatever it is, it takes forever to implement. It's implemented in stages. Eventually, it'll make things better. And you look at regulations going on in South Korea and now China, basically going after short sellers. It it will be interesting to see if that has any impact on Western financial regulators' thoughts, because it's like, we know that China banned Citadel, and yet that didn't stop Citadel from doing whatever they wanted in North America. But eventually, I have to wonder. The public outcry will say, look, naked short selling does exist. It's been documented by South Korea. They're going to jail people. If they go after expats, that'll be interesting. I don't know if there's extradition treaties between the U.S. and South Korea. But yeah, like if you were a managing director from New York and you spent some time in Seoul and you were screwing around the South Korean market and they decide they want to extradite you, that'll be interesting. So I'm looking forward to seeing how that develops. But the fact is that things are happening. It's just like does it help us immediately? No. Does it help us in 6 months? I don't know. Are we going to get rich in 6 months? I don't think so. I don't know. That's the problem. It could happen tomorrow. Like the thing is, like, crazy later trader always beats me up when I say like I don't know. It's like, well, it could happen tomorrow, and she's right. It could happen tomorrow. It just we don't know what will be the trigger, but we do know that things like the gamma ramps are going to be curtailed. So they're trying to limit MOAS opportunities, but at some point the game has to be up, and someone has to basically stop. The first person to sit down on the chair, right? That's who's going to be, and you know. Anyway, I've lost my train of thought here, but all I can say is like regulations are coming. It's just taking forever.
Well, and then at the end of the day, it's like when you look at it towards the way the economy is going, everything is going. It's in the fucking government's the government's best interest to let it happen in a sense to re-stimulate your economy, because you're not going to give out a stimulus package, but you got to re-stimulate your middle class. You got to get a middle class back, or again, these elites. All these guys, all these rich people, 90% of them live off credit. They live off their companies. They got their company as collateral, which is why they can get these loans. Well, now all these companies are doing worse. These companies some of them are going out of business. Now they're no longer rich because the things that made them are losing money because we don't have money to spend at their shops, so they need a middle class, and that's the problem. That's the problem with the United States. The way the United States was built is the banking system was always supposed to be in control of everything. There was always supposed to be a middle class. The stronger the middle class, the stronger the economy. Well, right now you have no middle class at all. It's gone. You've destroyed it. Banks are losing control of the money market fund. So the entire way the system's set up is evolving past it. It's moving past it. And, you got brokers now. You even have brokers offering 5.5%. They're offering more than banks. You know what I mean?
Yeah.
So it's like...
that is I'm sorry, you make a lot of good points, but the one that really stands out for me is exactly, it's like the banking system, and we talked about the shadow banking system, it really becomes a fact that like money is leaving the banks, and the entire... I don't know what that looks like because, again, the shadow banking system is not regulated as well. I don't know how this will impact the Fed and how, like, that they realize they need better monitoring of what's going on in the shadow banking because as this money's leaving the banks, it's going somewhere else. And who's doing what with that once it, how do you know what your money growth and all that crap is going to be if it's not in the banks? Because that's where you get your data to understand what's going on with the money supply. But the money's sitting in shadow banks and going to be, going to like lending out online banking to like some payroll loan, whatever, circumventing all the kind of regulations that are out there. It's like, who knows what's going on? So,
not to mention family offices, which already have 7.6 trillion in assets.
Yeah. Yeah, and again, family offices haven't had to report. I think that'll change. It's like I don't even want to get into the history of of those family offices, but yeah, like they're going to have to be more accountable in public, and there's going to be less places to hide because the regulators are not going to be able to otherwise understand what the hell's going on because everything's being deregulated.
Yeah, and that's the thing. That's why it's funny. You got like Hester Pierce and all this. We need less regulation. It's like, no. Anytime you see like just with the cat system, the other day, Ken Griffin comes out and he's sitting there whining about the cat system, and he's like, "This is just we don't want this. It's too transparent. That means that your guys' information is gonna be at risk." And here's the one thing I was telling everybody about the cat system. This is why they're scared shitless of it, because what the cat system does is right now there's only 2 times that it trades the life cycle of a trade. Right when it gets sent in, and then when they fill it, and at the end of it, after the T+2, that's it. That's when it's tracked. That's all that goes through. That's what the SEC sees. Well, right now, what this will do is it'll do it 4 times. It'll do it when I put my order in. It will do it the second, my broker sends it to wherever. The second wherever, the broker send it to. Whatever they do with it, whether they internalize it, whether they do this or that, it will ping and tell them that. And on the 3rd ping and the 4th ping, the problem for these guys is it attaches something called a revenue ID, or I'm sorry, a venture ID, and it tells you every single route that it took, the last place it went through. So if it's been internalized through Citadel, that now says Citadel, the venue ID is Citadel's internalizer. So now it says, the third ping, Citadel internalized this order for this person. He owns it. There's a date attached to it. Everything. Yep. It knows your name. It knows your customer ID, your broker ID. So now every single thing is attached to it. So now the fourth time when it comes back to you, they know the entire life cycle. And this is what it talks about even here on the bottom when it says that he complains about blah, blah, blah. Hold on. Under the consolidated audit trial, it says brokers and exchanges must report all trades, including those of options, equities, and over-the-counter securities. It's going to capture the entire life cycle of each transaction. The goal is to pinpoint the causes of market turmoil and market manipulation in particular. In 2010, in the flash crash, that briefly wiped off 10 trillion. It took the SEC a long time to track it. When with the CAT system fully up and running, it can take a matter of seconds.
Yeah, no, exactly. You can't overstate the importance of it, and that's evident in. Yeah, again, politics. Like, let's not forget Hester Pierce was a Trump appointee, so it's like much as I can't stand Gary Gensler and his weak ass like handling of regulations, it's like he's done more than and would have been likely if Hester Pierce had been in charge. So I really do not want Hester Pierce to be the next head of the SEC. So that and anyone but Hester. So yeah.
Well, yeah, when your number one fucking revenue from like Hester Pierce is a deregulation firm, that's her number one source of income is a deregulation firm. How can you be a regulator?
Yeah, exactly.
It screams conflict of interest, but yeah. So you went into the CAT systems. The last thing I wanted, I only got two more questions here for you, and then I'll let you go here. China's starting to finally do a crackdown on short selling. They've changed a ton of things over there to regain confidence. They've also replaced the head of their regulations. They just sentenced a CEO banker that was doing market manipulation, taking bribery, to life in prison. And he also has a special clause that if he misbehaves in prison at all, it's instant execution. Citadel now, a couple weeks ago, Citadel was able to get a sponsorship into China, and all of a sudden, a couple months later, all of this starts happening. And we already know how China hates Citadel and all of these things. Well, my question to you is, I thought it was kind of interesting that a week or two ago, or about a month, I'm sorry, not a week or two ago, a month or two ago, Citadel, they were trying to sell Credit Suisse in China. And Citadel was the only people to bid on it. Not only were they the only people to bid on it, they bid $5 million over. So they actually said, so it just shows you how much they wanted. They bid over ask. Do you think that Citadel is just trying to gain, more exposure into China's market? Which I don't believe is the case, because why would they with this new regulator? He's supposed to be really hardcore. Or do you think China's trying to get in there to get, those toxic assets and move them through derivatives market, through derivatives contracts to other regulatory bodies like Europe?
Yeah, no, and that's a good question. And as I said, you sent me the article. I had a brief glance through it. My sense is that, UBS was acquired this dog shit entity from Credit Suisse. So they're basically, UBS has been trying to clean up the stuff, and of course there's speculation of all kinds of stuff that UBS was saddled with because of Credit Suisse's activities in GameStop and AMC and stuff. There's who knows what they were up to in China. The ironic thing is, I was posting for a job last fall, and one of the applicants was from Credit Suisse Hong Kong, who dealt in the equity side. So I wish, like, if I'd hired him, I might have learned some dirty laundry. But I don't know exactly what the kind of exposure they would have acquired there. But certainly the fact that Citadel is like no one else wanted to touch it. So to me, that would send it to me that it's sending kind of toxic. But the fact is that you're saying that China hasn't accepted that bid yet?
No, China did not accept it.
Yeah, so they were not willing to accept above market value for that, which either says that China thinks the asset's worth more than Citadel was offering, or maybe they feel it's there's exposure there that they might want to look into more. I don't know. It's a very odd thing for Citadel to do. The fact that no one else wanted to buy it and they were willing to pay over market. So yeah, follow the money. There's something smelling there. The fact that Chinese didn't agree to it could be a whole bunch of reasons. Again, China doesn't always make logical decisions either. But the politics there is certainly something to think about. I thought that Citadel had somehow repaired their relationship with China, but who knows? But yeah, certainly the just smells. So I can't really venture more than speculation beyond that. But it does seem very odd. So my guess would be there is either some facility that Citadel wants that would give them better access to certain parts of Asia's equity side, or that they have stuff there that really they don't want to be brought to light in Asia, and they want to hide it. So that's speculating. I don't know.
Yeah, I just thought so because maybe it's that second one more because I was reading about this new regulator and they pointed him because this dude's like super hardcore. And the first thing he talked about was just he says, anyone that I catch doing anything is going to rot in prison. And the first thing he did was send that banker to jail for life and then instant execution. I'm like, dude, this dude's not fucking around.
Yeah, just incidental stories. So regulators from South Korea actually came to China for a visit. They're not. They're cooperating and talking. So, again, if it's South Korea and China talking together, who knows where it could go? I certainly wouldn't want to be, sitting in Manila, and I'm screwed around in the Philippine market and thinking like when is my turn coming? Because it's like it's not going to be just China and South Korea. It's going to be other Asian countries going to look into this as well. So.
All right, so the last thing I want to get into here is going to be, this is why I think in 2005, 2006, 2007, at the latest, I don't think, and I think there's no chance, I mean even a remote chance to even get to that. But one of the things that I thought was going to be the biggest end game to these banks is actually called the end game. Now the end game rules is coming in next year. It's going to start in 2025. And one of the things, this is what they obviously, this is a massive deal. Because if anyone's sitting there going, yeah, whatever, another rule. What other rule have the bankers protested and had a court hearing on? Not very many. What other rules right after are they've never in the history of the world before sued the Federal Reserve. And they're talking about suing the Federal Reserve over these rules. So it's a big deal. Now I'm going to explain real quick why it's a huge deal and why I think this will kill the banking system in general. Now, so with these new reserves, or with this new rule right now with COVID, that when COVID came in, banks no longer had to have reserve. They were able to take all their deposits and 0%. They didn't have to have. There's no requirement currently, and I have yet to see any ruling restrict it. Well, what this is going to do is for banks that are too large to fail, is it's going to require them to go from 0 to 30% requirements capital at all times. So they need to have that 30%, which does what? It massively lowers their revenue. Massively lowers it. Well, on top of that, if you have another 1.5 trillion this year leaving, well, we just went over how I think next year, I think the rates, honestly, I think by this time next year, rates will be over 6% on almost all the treasuries. It's going to be a lot higher, I believe. Maybe I'm wrong, but I believe over everything we went, there's no way that they can lower it because the demand won't be there if they do. And we can't stop spending. We just can't. We're not gonna. For me to bet on the rates lowering is like me saying I bet the government's going to slow down their spending and take care of it. It's just not going to happen. Well, with all of that going on and more people leaving their deposits and more options, but coming out, like I said, brokers are now offering 5.5. I think there's going to be more and more things out there that are going to offer, like PayPal's talking about offering things like that, where it's like, fuck, have your money in a bank, just put it over here, and we'll give you this 5 times more than they're doing. Well, with these end game rules and them having to have 30%, it limits, they're completely screwed. And now how many of them are going to need to start to collecting on these these contracts because they're not going to make that much money compared to what they were, and all these fat cats are going to be losing millions of bonuses. What are your thoughts on the end game rules? Do you think it's as big of a deal as I do, or do you think it's not going to be that big of a deal?
I think it's just indicative of the fact that banks' balance sheets will have to shrink. If you're going to try and you're going to have to stop making loans. You're going to have to stop it's just going to slow down activity, which is why you said it's going to be less profitable for the banks. So you're going to have to. The issue is that the banks are so big right now. You basically have no deposit restrictions. You can lend like crazy, and that's again the biggest issue that we've seen in the financial markets is the amount of leverage that's gone through the roof. So it's ultimately trying to restrain banks to be more fiscally fiscally prudent with their lending, because how many again regional bank crisis, it's caused by lending to dubious real estate developers who've created overinflated property values everywhere. So yeah, I think it's an attempt by the authorities to basically say we need to stop having a bank crisis and printing money to fix things. So we need to have better discipline in terms of lending, and to do this, we need to have the limits are kind of extreme as you noted. So I don't know if that's actually what's going to eventually pass. They'll probably find some compromise lower, but it is indicative the banking sector is losing deposits and they're taking too many hits on loan losses and things. And so yeah, you're going to have a slowdown in bank lending, or you basically regulate the non-bank sector so that the money comes back from the non-banks into the banks. But I think it's too late. The more I think about it, the points you brought up, I really don't think the banks are going to be as dominant as they have been, and you're going to have competition from the near banks, and it's going to be a long struggle for regulators to get a handle on things. But the main thing is, for now, I think they need to stabilize the banks. So there's too many crises. 2008 was okay, whatever, 14, 15, 16 years ago, but I mean, it's been one thing after another, right? It's like you cannot have every decade having a financial crisis. So the banks need to be better regulated. And again, if the banking switches from the banks to the non-banks, then you need the non-banks to be better regulated. So that's the next step. But the regulators are always behind the curve. So we're going to have the non-banks reign crazy. So getting Citadel to be registered as a dealer is one thing. Again, it's going to. It's an evolving situation. So yeah, I don't know if this is the death knell of the banks, this regulation, but it's certainly going to accelerate the trend out of mainstay banking into alternatives.
Which to me is not necessarily a bad thing either, because we have too much concentration of deposits in a lot of banks that are so easily just destroyed by some of these regional banks, and they sit there and they make everybody, FDIC's got everyone in the world and blah blah blah, and it's like, no, they don't. They showed you those just with those 4 banks last year. The FDIC ran out of money and had to borrow billions and billions more from those other people. And when they did that stress test, there was 190 banks that were negative and failed.
Yeah, no, exactly.
So it's like it's a big ass deal here. So last thing I wanted to ask. So I've always said since the beginning of this, once they got a hold on this, because here's the problem: is it happened one way with GameStop, and everybody thinks it's got to. Oh man, it's got to happen that way again, and everything. And I told everybody right away. These guys spend billions and billions and billions, and they evolve. They reprogram algos. Like it's not that hard for them to get some people in there and to reprogram the fucking algos, update it, make them changes. So they're gonna go cheat some more. So the way I said for us to always win, the way I believe that apes would always win, because they cheat once they figured out hey, they caught us. They weren't gonna let that happen again. They're gonna keep making their cheating fucking rules. And I'm like, you know what? Logically, how do you beat them? You just fucking cut the head off the snake. In the end of the day, Who is it? It's the banks that are constantly lending these guys money. Even if they can't afford it, even if they do it, they just lend it because they don't care. And they're allowed to do all this crap. So what you do is you put so much pressure on these banks, they have no choice but to actually do margin calls. I mean, just that number we went over alone today. The U.S. lenders debt $1 trillion in shadow banks. Well, for them to need to get that trillion back, you got to put pressure on the big boys, and that's why I keep stressing everybody. The year we're going to win is going to be the year when they can't control these bank meltdowns. Do you agree with that? Or because I mean, the regulators aren't coming to help us, so the only way to get it is to fuck your opponent up.
Yeah, I mean, it's certainly the banks have been the reason why the leverage. You can abuse these plays because you basically can leverage up to like 20 times or whatever your exposure, and to you need. This has always been the case. Like I thought, well, the Fed raising rates will be, I'm not going to repeat some old YouTubers, but the fact is that I thought that tightening financial conditions would basically help the squeeze because you would see these leverage plays being reduced. But in fact, the banks just kept lending them money. The instead of the higher financing costs offsetting them, they just basically doubled down and went crazy, even crazier on their shorts and the longs. So you've got the situation where you've got Nvidia pump again. I'm going to just pump it. It is a pure pump and play.
Oh God, we got to get to that question. I'm so sorry, we didn't get to that
No,
question.
it is just it's obnoxious. Like I don't even play Nvidia, but you can use some kind of rational thinking here. It's like if chips are the way to go, how long will it take for alternatives like Microsoft or whoever to produce their own chips? It's not like Nvidia has a sole monopoly on chip production, and they'll be able to continually sell at the huge again. It's like, okay, this is all fueled on some sort of like AI tech boom. Okay, so assuming that is the case, and there'll be rising demand for AI chips, it's like there'll be competitors. There'll be people to undercut you. It's not like you can continue to produce and sell all these, but you're not really selling these chips. You're selling them to cloud companies that are stockpiling them. And the question I keep asking, and I never get good answers, are what is the depreciation term for a computing chip? And I've had people tell me, oh, it's about 4 or 5 years, or it's like, okay, but like if 50% of NVIDIA's sales are being stockpiled by whoever, whether it's a dummy company of NVIDIA or whether it's a hedge fund run cloud company, the chips are being stockpiled in expectation of future demand. How realistic is that? And even if that is the case, that the demand will be there, are the chips that they're stockpiling are going to be valid for the demand in 5 years? And is this demand based on the fact that they think China is going to invade Taiwan, and then there's going to be a major chip distortion? So I can sort of see the fundamental play story behind it, but it seems like it's like anything. It's been pumped to the degree that I feel like it's a manipulated piece of crap. And and then China, whatever the story yesterday was, Nvidia's market cap is worth more than the entire Chinese stock exchange. And it's like, I remember when there were stories about Tesla being worth more than the rest of the automotive sector, and it's like, okay, I don't think Tesla is a bad company. I think it's got promise, but is it worth them the same as all the other manufacturers combined? No, there was obviously some over pumping there. So, and you latch onto the fact that, yeah, like if the shorts were using the reverse repo account as their collateral and getting 100% treasury collateral, and then they're reducing their reverse repo, they need new sets of collateral, and the best collateral would be is a high value tech stock that's got a fundamental story behind it, so the banks are willing to give it a high haircut. So it just smacks to me of being manipulated for the sake of being used as a collateral, SOP, and basically offsetting shorts. So I mean, it just is. But and I said to post the other day, it's like, do you want to short it here? Well, you could try, but then you run the risk of getting nuked, as everyone else that's tried it before. And so there's no, I don't know where the games stop. And again, it's like, who sits down on the chair first? Because like at some point, Nvidia is going to collapse, in just case down of like it'll have to puncture the fundamental story. It's like, oh, all those chips that were sold, no one's using them. So that's the question. Is I don't know how long I need to wait for that data to come out. But when it does, it'll show whether this has all been a pipe dream or not. But it really does smell like a pipe dream to me. So, and that's not confined to NVIDIA, that's confined to everything that's relying on this AI chip that hype as being the way of the future, and that it's going to be creating instantaneous demand for chips.
And I mean, that's the thing too. Like that was going to be our question is, one of the reasons I've said, this is actually getting close. It's not just the banks is getting all of this pressure. It's the fact that the banks, all of their lenders are now finally getting squeezed, but they're all running to the same hill. And like I was telling people on my last stream, it's like they're all running to a hill full of fool's gold, and they think it's full of real gold. Because if you don't know what's going on, anybody listening, what's going on with NVIDIA, they're cooking their books. Through 2 years ago, I exposed Coca-Cola and how they do something called supply chain financing, and it's how what should be a cost or a liability and expense, by paying that to your distributor, what ends up happening is a bank gets in the middle. Of course, it's always a bank that helps commit the crimes, and then the bank it basically writes an ISDA contract. Hey, you're gonna borrow or I owe you $1 million. But what ends up happening is the bank pays the distributor $1 million. Now what Coke can do is keep that billion. Well, what Coke was doing was saving them $1 billion a quarter, which is a fucking joke. But what they do now is what would have been $1 billion in expenses to your distributor now shows up as, you still have it on hand. It didn't go anywhere. And then after the quarter, at the start of the next quarter, you pay that money to the bank. So you're cooking your books, and you're always showing you're making $1 billion more than you should have, and you have zero expenses to your distributor according to your books. Well, what NVIDIA is doing is they're buying instead of what they used to do is they found a loophole. Instead of buying these startup companies, they go up to them and say, "I'm going to give you a $400 million, but in return, you're going to have to buy all $400 million in my AI startup chip." So then that firm's like, fuck yeah, of course, because now I can go out and I can go get a round of I could go out to other people that will, donate to us or now get jump into my company because, hey, I already have a $400 million start from NVIDIA. Holy fuck, my company's already worth a huge amount of money. Well, then what happens is a bank comes in, a bank pays fucking that startup company, and then NVIDIA, after the quarter, pays the bank back. So basically, NVIDIA is buying their own chips, counting it as profit, and then they're saying demand is through the roof, so they have to put the prices way up because fucking demand's through the roof. So they're cooking their books and they're cooking their prices, but in the end of the day, they're buying it themselves. And then what happens is they screw over all the other investors, because what NVIDIA does is, hey, the company's worth $1 billion. All these other investors invest up to that, a valuation of fucking $10 billion or whatever. So suddenly they make hundreds of millions of dollars, and that startup company just pays NVIDIA back. And then it's all done, and then they move on. It's like, what a joke.
Yeah, absolutely. I mean, you just nailed it there. Exactly. It's just using accounting rules to pump up sales, and it's just it's obscene that people are falling for it. But there it is.
I mean, and then like the thing too, like if it wasn't the telling question, look at the CEO. Why did he sell he sold like 50 million shares? A couple months when CoreWeave was first exposed, he instantly sold 50 million shares because he probably thought, oh my God, we got exposed, we got to go away. But they haven't. Instead, all they do is just keep opening up new shell companies, keep getting a bank involved, and cooking their numbers to where it's like you said, what happens if AI doesn't take off? Well, basically, they cooked all the other investors now that invested into all these other startup companies are all going to get just dismantled.
Yep. Yeah, I mean, I honestly believe that AI will change things dramatically, but the time frame is uncertain, and the expectations that have been built into the prices are so far from reality. It's really hard to envision that happening in the next 5 years. So.
Well, that's the thing. It's like they're pricing it in like it's happening tomorrow. Like you're saying, like it's not coming out for years the way that people are thinking. People are just going crazy because they're seeing the little goggle things and stuff they can do, and instantly people think of movies and all these things they saw and like, oh, AI is gonna be crazier than hell. But I don't know. I just the fact that it's worth more than China, Nvidia alone's worth in China more than China's entire stock market. It's like everybody's pumping. I always said that they would end up running to the same hill. They would all end up running onto the same thing as one last effort to pump everybody's collateral up at the end. But in the end of the day, it's just going to take that one. And this is how I said we get to that MOAS is we have them all jump on the same hill. And once they all they're all on the same hill, then we cut the head off the snake of the lenders. And now the lenders have to recall one guy. Well, even if they recall one, if they're all on that same hill and that guy's, all of his assets are in that part of the hill and he has to sell that off, that's where you trigger tons and tons and tons of people because they're all on that same hill and that's all their collateral.
Yeah, exactly. So it's maybe not just be NVIDIA, it may be Microsoft, it may be Amazon, but once one goes, the other is going to likely follow. So yeah.
And that alone could trigger our MOAS because in the end of the day, logically, if we all know regulators aren't going to help, the only way to do it is you cut the head off the snake or you take away all their collateral to the point where nobody will lend to them. But that's the problem I feel like right now is, like you said, the banks saw all these guys were over leveraged 20%, but they still gave them money because they were like, well, we can still get bailed out. Well, if the feds are now finally starting to control that a little bit more, that's pressure on them. If the rates are going to stay higher longer, well, that's pressure on them. If the endgame rules do get put in, well, that's pressure on them. And it just takes more and more building up to where they just can't stop.
Yeah, at some point, you either give up on the entire facade or you actually do try and scale back some of the liquidity that's been created. And my sense is that at some point, regulators, the rules that are being put out are way too late, but they're probably with good intentions. So, but in the meantime, it's been hell for us. So, and it may take a little longer, but eventually, this is unsustainable. What's going on? So, if I had to leave this call with one impression, it's like, the games that have gone on will continue to go on, but in a different form, and probably not to the scale that we've seen. And at some point, the AMC and other shorts have been like taken to extremes, and that will be exposed as regulations come online.
I agree, and a lot of people, like I said, the end game rule, they wouldn't be protesting and suing the feds if it wasn't a big deal. Like we've never seen that before, guys. We've never seen.
Keep in mind, the Fed is owned by a consortium of banks, so it's very interesting. You're suing another department of your own organization, right? So.
That is pretty funny. I didn't even think about that. Yeah, you're pretty much suing yourself for trying to stop yourself from committing crimes. Like what?
Yeah.
But thank you so much. Did you have anything else you wanted to talk about, or?
No, other than. I could just waffle on about Putin and stuff like that, so I won't. But it's been a pleasure, and we can probably do this again as long as Twitter doesn't put you in jail. So.
Yeah, that was fun. I like how I said I just want to. I didn't even say anything else, like nothing violent or nothing. But yeah, let's do it again next week here. I mean, I do have a lot more things I wanted to ask you about, but I mean, we already went for 2 hours. I don't keep you too much long.
All right, sounds good.
Thanks, man. Have a good day, Peter.
Talk to you soon. Bye-bye.
Alrighty. Thank you everybody for listening. Does anyone have any questions? Otherwise, we went for 2 hours. I'm gonna probably go. I do have a lot of stuff that I think I'm gonna go over tomorrow or Tuesday still. But like I said, guys, if you think logically, the way you get your MOAS is you get them all on the same hill, which they're now all on the same hill. They're all their collateral is the same collateral. They're all, if one of them goes down, they all go down because all their collateral suddenly loses value. So fact that they're all piling onto these same hills is good things. Everything that's going on with these banks. This is why I continuously scream, get deposits out as much as you guys can. Show your family members. Don't just be like, well, I got myself out. Show your family members. Guys, you can make 5.6% over here in money market funds, or you can make 0.2% at your bank. There is no reason to be there anymore. On top of that, I mean, anytime you try to get your money out of these banks nowadays, it seems like it's more of a fucking hassle than anything, too. The more pressure you put on their lenders, there's nothing these guys can do but have a choice to margin call them. And that's what it's all about. Making the people that can margin call them have to margin call them. The fact that they've passed $1 trillion in shadow debt is insanity. They've given everybody that goes, where is our MOAS money? They've given them $1 trillion. There's your MOAS money. People that say, oh, they can't afford it. Well, this is just the shadow banks that have $1 trillion. They can afford it. And eventually your economy is so fucked, you have no choice. Your banking system is so fucked and it's getting moved on. It's getting involved. It's getting moved past. You got to look at it and say, is the banking system worth saving? Do we let it go down to, we have more banks. There's like 4,500 type something banks in the United States. There's more banks in the United States to like I said, compared to our currency printed than any other country. We don't need this many. They can start to go away. The fact that 1.2 trillion is going to left last year, 1.5 trillion will leave this year. That just shows you don't need that many. Like I said, the banks are going to get fucked up. People that have been lending to these guys, these middle banks, smaller banks, they've been lending also from some of these. They have loans also with some of these bigger banks. They're going to take hits. Just relax, support your company. If you're in AMC right now, let's look at domestic box office, Q1. If you're in AMC, guys, support the fuck out of your company. We're at 617. We need to break. I can see us having a great, like I said, I can see us having a great month next month. A very good month next month. But we have to get over $1 billion. We have to break $1 billion to get to at least, manageable, to where we don't have a massive cash burn. A lot of people are going crazy thinking we're going to have this huge Q4, and I still don't know. I don't know. I don't see it. I don't see us having this massive Q4 like everybody does. I think we are going to lose a little bit of cash. We're going to beat our earnings for the 11th straight time. But all these people that are out there thinking AMC's crushed it in Q4, I promise you we did not. If we would have had Dune 2 like we were originally scheduled, yes, Q4 you would have fucking just crushed it. That's what I'm saying. If you're an AMC right now, just support the fuck out of the company and relax. Anybody talking reverse split, you're an idiot. Just relax. The price will rebound. We just got to make it through. AMC's not going bankrupt anytime soon. They're not going to not be able to pay down some debt. What they're going to do, again, is they'll do some more of these debt for equity exchanges. They're going to do these private offerings. And at most, I can see AMC doing one more equity raise of about 50 to 75 million. And that's to manage the cash burn that happens in Q1 and Q4. And then after that, you still have over $900 million. There's anybody that's sitting there going, they got to raise capital. No, they don't. They just need the box office to rebound. They need to get some good, another revenue stream. They need to get some good news. They need to get some distribution deals. And hopefully the NFL contract licensing gets signed. Hopefully the alcohol comes out very soon. That's it. Just let your price rebound. Everybody going, oh, fucking hey. Just let it rebound. It's going to rebound. It's been oversold for fucking ever. AMC's price makes no sense. If you're the only person that would be in here going, yeah, is fucking a clown. Yes, AMC with less debt, more profitable, more new revenue streams, popcorn out in the store, candy coming out, more coming on the way, distribution, which they didn't have before. Well, the stock's worth less than it was now when it has all these new things than when the doors were closed. Again, you're a clown. Get the fuck out of here. It will rebound. Just relax. When it rebounds, Adam Aaron, if he ever needs to do another capital raise, can do it then. AMC's not going anywhere anytime soon. Just relax. We need the box office to recover. And that's why he put that tweet out Everybody, Q1 sucks. It sucks ass. I already showed you. February movies suck ass. They're not. There's not that like holy fuck movie out there. There's not that one that's gonna bring in a couple $100 million. I don't see it. I just don't. It sucks. I've told you guys forever. This writer's strike was a pile of shit. And for this first month, you're gonna see the after effects. And in Q4, losing Dune, when we should have had a profitable quarter not be profitable, you're gonna see the after effects. But after this, we're back on track. 2025 is supposed to be even better. 2026 supposed to be even better. They're talking about 2 Star Wars movies now coming out then. Star Wars movies kill it. Like I said, they're going to now start to write better movies. And I know a lot of people are like, 2026, we're going to have to wait that long? No. My point is people that are sitting there that bought at $350 and now we're back up. I mean, I can't say anything because anything I say, people cry about. But I have these people that were, I'll buy at $4 or $5, $6, $7, $8, $9, $10, but then they're like, oh man, we're at $4 and they go crazy. Well, wouldn't that be a buying opportunity to you? Every single thing from AMC from this point on fundamentally goes nothing but catastrophically up. So just chill. Just relax. Get this number as high as you can. That is your goal. Instead of coming on every day going, oh my fucking God, AMC went down 20 cents. And then a week later, we're up back where we were. I told you guys, they're going to hold us between $3.50, $3.75, $4.50 to $4 in that range. They're going to hold it there for a little bit. They're going to try and shake people out, and then they're going to go, then you're going to have all these people crying, oh, the reverse split's coming. There's no talk of reverse split, and it makes no fucking sense. There is zero reason to do a reverse split, and there's literally no reason. I don't even know why so many people on Twitter are even talking about it. Adam Aaron has not even mentioned it. There's nothing about a reverse split that makes sense. The only reason it made sense was we had to also, last time, put ape into the common. Well, if you're combining them, you don't want to have a massive common float, so you fucking reverse it quick. AMC should have been able to raise capital, but of course they were able to do what they do, fucking cheat it right back down. So again, everybody just calm down. Go see a movie. And that's the thing. I mean, I'm watching Twitter. I don't know if you guys, if you don't have a Twitter and you're an AMC, I'm telling you, every day I'm watching these people go online and they're posting pictures of them going to AMC and buying $200 of the almonds and the pretzels. Let's fucking go. But it's like, I'm sitting there, so it's like the amount that those sales could be doing too is massive that none of these other people are getting. Like I said, these revenue streams that we're creating, if you think AMC's price logically makes sense that it's worth less now than when the fucking doors were closed, I don't know what to say, guys. But go see a movie, my friends. Enjoy the Super Bowl tonight. If you're getting drunk, I'm going to say it, dude, just be safe. Don't fucking drive. Don't do stupid shit. Too many people. I know somebody personally, just be fucking safe. Don't get drunk and do something stupid. But have a good night, guys. Appreciate it. We'll see you guys Monday or Tuesday. Oh, shit. And before I end this, I apologize.